A shipping container left Germany in March of 2025 heading toward the port of Houston. Inside were industrial machines ordered months earlier by an American construction company. Now, the price had already been agreed upon. The contract had been signed, the delivery date was locked in. But then the invoice arrived. It was higher than expected. Not dramatically higher, not enough to cancel the order, just high enough that the finance team opened a spreadsheet and started asking questions. Now, nothing about the machines had changed. Same factory, same materials, same shipping route. But if you dig a little deeper, you realize the one thing that had changed was the currency. Not the currency that was being used, but the actual currency, the US dollar. The US dollar had weakened. And that one invoice is a tiny window into a much bigger story. Because in 1 year, the US bought about $430 billion of goods from China, $475 billion from the European Union, and $418 billion from Mexico. Every shipment entering American ports is paid in dollars. But by the end of 2025, the dollar had fallen 9% against major currencies. That was its worst drop since 2017. So my question is, why is the US dollar crashing right now, and what happens next? Okay, so currencies move constantly. That part is normal. But what makes this move so unusual is when it happened. Historically, the dollar rises when the world feels unstable. During wars, financial crisis, recessions, investors like to move money into the US. US government bonds are treated as the safest financial asset on earth. It's usually the safe place to put your money. In 2008, the dollar surged during the global financial crisis. In 2020, it surged again during the pandemic. Now, in 2025, global tensions were rising again. Trade disputes were escalating. Geopolitics felt uncertain. But instead of money rushing into the US, it's actually been drifting away. And that shift began months earlier with a political announcement that sounded like trade policy, but it actually carried global financial consequences. It was the moment after Donald Trump took office, stood in Detroit, and announced the huge tariffs. Tariffs of up to 60% on Chinese goods, new tariffs targeting European cars, expanded tariffs covering thousands of imported products. Financial markets reacted like crazy. Stocks dropped sharply. Now, since then, they've gradually recovered, but the dollar has not. This is surprising economists because tariffs do more than change trade. They change how companies design their global supply chains. So to get why all of this matters, you need to understand the role the US dollar plays in our world. The US imports about $3 trillion worth of goods every year. That works out to about $9 billion every single day crossing American ports. I mean, walk into a Walmart and most things are coming into the country from other countries, but all bought, of course, in US dollar. But now zoom out. When Egypt buys wheat from Ukraine, that deal is priced in dollars. If Vietnam buys machinery from Germany, the invoice arrives in dollars. If India buys oil from Saudi Arabia, you get the point. Now, America is not involved in those transactions at all, but its currency is. Around half of global trade invoices are written in dollars. About 60% of global central bank reserves held in dollars. Nearly 90% of currency trades involve dollars. The world constantly needs the dollar just to function. That demand gives the US enormous advantages. It allows the government to borrow cheaply, run persistent deficits, and sustain a debt that now passed $34 trillion. And for decades, this system quietly supported American living standards. So currencies move when investors decide to change where they're investing their money. Every day, pension funds, central banks, hedge funds, and governments decide where to park trillions of dollars. They compare the US with Europe, Asia, emerging markets, and gold. And for decades, a huge share of global money chose the United States. But this is the shift. In 2025, more of that money is spreading. What's so interesting to me about this is there was no panic, no crash. Investors just began parking a slightly larger share somewhere else. Even small shifts matter when trillions are involved. Companies that had spent years building their products in China now faced a new reality. The factories were still reliable, the shipping routes were still efficient, and the relationships were still strong, but the math had changed. new tariffs meant every shipment entering the US now arrived with a much higher bill attached. So companies started exploring alternatives. Within months, executives were visiting industrial parks in northern Mexico. They were running new cost calculations and testing shorter supply routes. Producing closer to home now made more financial sense than shipping goods across the Pacific. This kind of quiet shift began happening across industries. European manufacturers started sourcing components from inside Europe. Asian companies are building new facilities closer to their regional customers. North American supply chains are tightening and moving inward. See, these kinds of decisions take years to reshape global trade, but investors don't wait years to see where they're going to invest. I mean, think about that up-and-coming, booming new neighborhood or new city that's being built. That's what investors are thinking about. When they see companies preparing for a future with fewer goods crossing oceans, they begin to expect a future with fewer global transactions that are priced in dollars. And when that expectation spreads, money starts moving long before the factories are finished. Imagine a soybean farmer in Iowa has spent years selling crops to China. In mid-2025, new tariffs and trade tensions made those sales a lot harder. Chinese buyers started sourcing more soybeans from Brazil. Brazilian exports surged. U.S. exports fell. That shift means fewer global transactions involving the dollar. Now, multiply that story across industries and countries, and the global demand picture begins to change. Okay, at the same time, the U.S. government passed $34 trillion in national debt and is now paying close to $1 trillion every year just in interest. The government issues more treasury bonds to cover that spending. Investors buy those bonds using dollars. But the more debt the US issues, the more dollars that end up circulating around the world. So while global investors were starting to spread their money into other currencies and assets, we're now starting to see the supply of dollars growing. More dollars available, slightly fewer people wanting to hold them. And that combination naturally pushes the value of the dollar lower. Let me take you back to 2022, when the US and its allies froze about $300 billion of Russia's central bank reserves after the invasion of Ukraine. Governments around the world noticed. The dollar's share of global reserves fell from 70% in 2000 to roughly 59% today. Gold purchases reached record levels. Countries expanded trade using local currencies. In 2023, China and Brazil signed an agreement to settle trade directly in yuan and reals, removing the dollar from billions of dollars of agricultural and energy transactions. Brazilian soy exporters who once priced shipments in dollars began invoicing Chinese buyers in yuan instead. Then we saw India starting to pay for portions of its oil imports from Russia using rupees and UAE dirhams, bypassing the dollar entirely. That shift covered billions of dollars in energy trade that would normally flow through US currency. Now, why does all of this matter so much? Well, because for decades the world has needed dollars. That demand quietly made life cheaper inside the US because it helped keep interest rates lower than they would otherwise be. It allowed the government to borrow trillions at relatively low cost, and it let Americans buy a ton of foreign goods without feeling the full price immediately. It was an invisible advantage baked into everyday life. But when global demand for dollars starts to shift, the effects eventually show up everywhere. Mortgage rates, government debt costs, inflation, the price of imports, the strength of the US economy itself, even geopolitics. Now, hold on. The dollar did not collapse. The world is not abandoning it. The US is still the largest economy on earth, and the dollar is still the most important currency in global finance. But something changed. For the first time in decades, the rest of the world is seriously preparing for a future where the global financial system doesn't rely on a single country as heavily as it once did. Trade is becoming more regional. Now, none of these shifts are necessarily dramatic on their own, but together they tell a story. For 70 years, the dollar has sat at the center of the global economy. Now, slowly, other centers of gravity are forming. So it's not the end of the dollar, but it's the end of the world assuming that the dollar will always sit alone at the center. And that is a much bigger story than just this 9% drop. I want to know what you think, so let me know in the comments below, and I'll see you in the next one.